news leadership.
Good morning, hello and welcome to a fresh new edition of Bazaar Morning Call, the last Bazaar Morning Call for the week. I'm Prashant, with me my colleagues Sonia and Nigel. Guys, hi, good morning. This promises to be a long day for no other reason except the fact that we've got two quarterfinal FIFA matches, right? Late into the night.
I don't know about you guys, but after a long week, interest it'll wane through the end of the day, but let's see.
Maybe the first one, Sonia, right? The first one is early enough. I think about 8:30, right?
Yeah, who are you going with?
I mean, it's a tough one. I mean, I'm kind of neutral with this one.
I think the midnight game, I'm going with the underdogs. I'll go with the Netherlands. And
always go with the underdogs. But I mean, this FIFA World Cup has been about the underdogs.
About the underdogs,
that's true.
absolutely.
But Messi has been playing some of his best football, and on his day, I think he can beat anyone. So let's see how that works. 12:30. We need to save up some steam for the midnight game.
It's too early in the morning to even think about the midnight
so
tonight.
Maybe an afternoon nap.
Long day
and then, save energy all the way for later in the day. Let me just quickly get back to the market. Just quick run you through what the setup is looking like this morning and get the ball rolling. So, we had a reversal. This late into the year, there is no let-up in excitement with these surges and these sell-offs. One would have imagined, and I think it would, volatility, etc., would reduce as more and more market participants head out to holidays, etc., but not yet. So we have seen reversal moves in US, especially across tech stocks. The tech index, the Nasdaq, for example, was up, in a significant way, 1.25% or so. But some stocks in that index moved quite a bit more. The S&P is reversed exactly from 3,900. 3,900 has been a pivotal level around which, the markets on the S&P has taken either support or it's acted as a resistance. It's bounced off that level once again. Oil prices have jumped. We saw a big jump, about 3%, 3.5% or so. There's a big US pipeline system shutdown. But oil prices sold off again. And this is a very bearish signal for oil that even with supply chain disruptions, prices are not able to sustain. And this is not as if prices were running up and then, you had this bounce which got sold into. Prices have been falling. There was the supply disruption and prices head back down again. It's good news for India from a macro perspective, but so far the impact of falling oil has not been a positive one for risk assets like equities around the world. It's more been on the lines of a deflationary impact. We'll discuss more about this. Banks yesterday coming to the action here surged, and I think that was basically the last hour highlight. Bank Nifty hit a new high. Three stocks. That's ICICI Bank, HDFC Bank and Axis Bank made up about 80% of the Nifty Bank rally that we saw in trade yesterday. I would imagine that is a space to look for ideas, to look for setups, positive setups if you want to go for longs. I think that was entirely responsible for that 50-odd point closing gain that we had on the Nifty as well. For the Nifty, I've just charted some retracements. The 38 and the 50% retracement of the recent fall that we've seen is 18,665 first, which is not very far away. It's about 50 points, 60 points away from where we closed yesterday. And the next one, the 50% retracement of this fall, is 18,708. So these would be the levels to take out. And these would be the levels around which you should expect to find some resistance as well. On the downside, as we've said always, the 20-day for the last many days is something we've highlighted. That's now around 18,488. And that's something to watch on the way down. Hopefully, we didn't get there, by the way, even with the sell-off that we had over the last 2 days. We bounced off before that. So that's the level to watch on the downside. Later in the US session, we get US PPI. That's Producer Price Index number. Next week is CPI. Just an interesting anecdote. This is only the second time this year that you got the Producer Price Index number coming in before the CPI number. And that's why there is a lot of chatter, about the importance, the significance of this, etc. But just remember one thing. Producer prices are what producers pay and what vendors absorb. There is, vendors may decide to absorb, companies may decide to absorb. The CPI is the real deal because that's what, at the end of the day, hits consumer wallets. So a lot of chatter around the significance of PPI and how that may move markets. But I would say, the big one, of course, is CPI. And then, of course, the FOMC 1 day later. But that is only next week. Sonia, hi. Nigel, hi.
Hi, morning. So there's lots to watch out for next week, right?
Yeah.
But given the positive handover this morning, it looks like the start at least will be in the green for the index. The SGX Nifty is now up in excess of about 30 odd points. And for our own markets, okay, it's almost an 85-point gain now. So it's going to be a big opening. For our own markets, Prashant was pointing out the key levels, but by and large, it's been a range-bound market between 18,400 to 18,800. And the buy on dip strategy is something that has worked over the last many days. So perhaps even in trade today, it could continue. The only thing is FI selling, there was a large figure yesterday, a sell figure of over 1,130 crores. It was not compensated as much by DI buying. So generally, by the end of the year, before the year ends and FIs go on holiday, there's a little bit of money that sort of moves out. So that's what's taking place. There was a long build-up in the banks yesterday, as Prashant was also mentioning. So perhaps this record high that the Nifty bank saw, the momentum could continue over there. Just a couple of things that I want to mention. Motilal Oswal put out a very interesting note where they said that the next big trigger for the market, one of course is Brent moving lower. That also ties in with a lot of commodity costs moving lower, and that's positive for Indian macros. And hence, there is a margin expansion of corporate India that's being spoken about in the Jan to March quarter. So in their report, Motilal Oswal spoke about how there's a 220 basis points expansion of margins across their coverage universe, and the sectors to focus on are cement, metals, auto and consumers. So these are the four sectors that could be big beneficiaries of a margin expansion. So just keep these pockets in mind when you're looking for the next triggers for growth. And of course, lots to watch out for next week, right? I mean, there's the US CPI data, the FOMC meeting, the ECB meeting where there's a 50 basis points rate hike expected. So we have our work cut out, although it is towards the fag end of the year. But what are you watching, Nigel?
Well, yesterday, the final hour of trade would be a weekly options-related expiry as well, and that's why the Nifty Bank did so well. So yesterday, you had the Nifty Bank call writers. Well, they got cleaned out yesterday. They got stumped on the wrong side. The broader markets, though, there is some participation out there, and that's what's making portfolios look good. And that's something that I like. The Nifty, though, is still pretty much in that band, the 350-400 point band. Let's address all these points. On the index futures itself, yesterday there was a bit of short covering that played out on the Nifty. The open interest was lower, the Nifty was higher. While on the Nifty Bank, it had a bit of a breakout day and the open interest surged more than 10%, telling you there was fresh buying out there. Perfectly ties in what the FIs did. They covered some shorts, they added some longs, and they continue to remain net long on the index. On the option side of things, well, the Nifty Bank, let's take that first. 43,500 put was very active in trade yesterday. Total open interest was up by more than 10 lakh shares odd, and the premiums around 240 rupees odd. So the sense you got was there was writing out there. Remember, the premium on that strike was more than 400, 450 as well. So given that there was writing out there, the support zone is at around the 20 DMA. That's far deeper. But in the near term, that 43,000 odd mark should be an important support zone. On the Nifty, the 18,600, 18,600 put as well as call, both of them were very active in trade. And just going by the kind of writing that we saw at the 18,600 put, that's giving you a sense that you have some support at lower levels. So, if you're going to get that bounce, that could get sold into. So on the Nifty, the 20 DMA, that's been gradually moving up from around 18,400 odd. That becomes a bit of a support zone. And also on the upside, till we break out, and make fresh highs, my guess is still we're in a bit of a band. Everyone's talking about the Nifty Bank, but the joke on the pack for me is going to be the IT index. Nasdaq did well overnight, and that's been an underperformer this week. Can the IT index come to the party? That's what will let the Nifty move higher. For starters, SGX Nifty suggesting a gap up. My sense is don't rush to buy the opening because that's a big gap up. In today, you'll get a bit of a dip, and buy on dips has worked. So maybe you stick to that.
Okay, well, the other big stock, and of course we'll discuss this in greater detail, there are two stocks that are very important today. One is Paytm because of the buyback that they have announced, and a lot of the market feedback through the course of the last 24 hours is that this could be read as misallocation of funds perhaps because of, using cash on your books to buy back in a loss-making company is not generally the best way to move around. Also, it could be interpreted perhaps as trying to maybe boost the stock price, get more investor confidence back in. They could have maybe, utilized that cash for better reasons, and that's one interpretation. But let's see, this is definitely going to be a stock on today.
Just a point's taken, and I think that that kind of commentary is doing the rounds, Sonia. But I would say that it's par for the course because the stock has fallen so much, right? I remember on the day of the listing, that is day one. We had VSS, Vijay Shekhar Sharma and Madhur both with us on that interview. My last question, that was day one, a little over a year ago, my last question to them was, will you, I mean, of course, markets are markets, prices may move up, they may move down, they may stay here, but if they stay here or fall more, would you consider somewhat, somehow compensating investors who believed the story and decided to come in? Of course, it was day one. I mean, I was not expecting a clear answer to that. I mean, nobody would have thought that, you'd see a 80% price damage. But a year later, we are seeing a buyback. I would say, I mean, my personal opinion, nothing wrong with it. They are basically trying to, and we've seen this, right? I mean, if the promoter feels that there is value in the business, I mean, you announce a buyback and you try and kind of stabilize the price. We, for example, last Friday had put out data which showed that a lot of these companies, not all, and I looked at 5 companies, Paytm, PB Fintech, Nykaa, Zomato, and for at least 2 of these 5 companies, valuations have now fallen to where some of the global peers are trading at. So that's something which is, I think, is also important. It gives some amount of comfort that valuations are not completely out of whack with what is happening around the world. So I would look at this positively. The other point is that 13th is the board meeting, so we'll get the contours of how this buyback is going to proceed then, right? Is it going to be a tender? Is it going to be an open market, the price, etc.? And I think that is critical to watch out as well. But I would say, views can diverge, and that is what makes a market. And so my view is, I think this is good. It's good. Perhaps should have come even earlier.
Just one word I want to make out there. Yeah. As of now, there is no promoter entity that has been categorized, right? Yeah. So I think if it's really going to be a sentiment booster, then the people who are running the business, Mr. Shekhar and the likes, they could put out a statement, we are not going to participate. Yeah. That could be a bit of a booster. If you really want to give confidence, you say, I'm not going to tender in. I'm here for the long haul. And this buyback is taking place to support the stock price and, to give confidence to investors. Yeah. But I'm not participating in this. I think for me, that will be the most important, given that there is no one categorized as a promoter out here. But people who are running the company, well, they have still large stakes, as is disclosed on the BSE. So that's my short point on that. Okay, well, lots of opinions on Paytm. Let's see how the stock moves today. Will be very interesting. And of course, HCL Tech has just announced that they have they've lowered their guidance in a way. We'll talk about that in greater detail too. But first, let's kickstart the show. We have commentary coming in from Surendra Goyal of Citi, who says that India's macroeconomic stability, relative resilience, EPS growth and conducive flow environment justifies premium valuations, but the upside potential appears limited. He expects the market to consolidate and would selectively buy on dips, with their long-term view remaining positive. He says their December 2023 Nifty target remains 18,300. The bull case Nifty target is 20,200, while bear case target is at 16,100. All right. Well, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We're tracking Paytm, HUL, HDFC Life, SBI Life, ICICI Prudential Life, Star Health Insurance, Triveni Engineering, JSPL and SAIL. All those stocks on our radar on the back of positive news flow. But since HCL Tech, well, they pulled back a little bit and on their guidance, what they had guided earlier, well, that stock could open up in the red.
Okay, let's get some technical perspective, price action perspective with Lawrence Belanco of CLSA. Lawrence, it's always a pleasure to welcome you on the program. Thanks very much for your time. So how are you looking at things as we grind into the end of the year, Lawrence? How are global setups looking, US setups looking, index setups looking, and where's the Nifty place for you?
Yeah, so we're still looking at further gains into the new year. The surprise really being an overshoot of the 200-day moving average for the S&P. So we're still looking at a 4,200 upside target on the S&P. And then for the Nifty, we're still on track looking at that 20,185 upside target into the new year. So we think these trends continue to extend and surprise on the upside. For the US market, though, we still think this is still a bear market rally rather than the start of something more significant. But near-term risk is to the upside and towards the 4,300 area on the S&P.
Okay, so you said 20,185 is your Nifty target, right? I didn't get the timeline. By when do you expect that target to come through?
We're looking at that into January, February, so start of the new year.
Okay, so start of the new year, the Nifty could hit 20,180. Will it squarely be led by banks again? Because the bank Nifty is at a record high as well. Or do you see new leadership emerge?
I mean, we've stuck with banks as the key driver for the Nifty's uptrend, and that really hasn't changed. We do see some laggard potential in the IT sector. If you look at the broader IT sector chart, you've got a double bottom, which you're emerging from. So we think there's some catch-up trade there, but the key leadership group is Nifty. The other sector where we can see some breakout potential is the Nifty infrastructure sector.
Hi, Lawrence. The headline index for us has been doing very, very well. And I like the target that you've given from a bullish perspective on the Nifty. The problem is the breadth of the market hasn't really improved. And that still has to do some catch-up. On the small cap index as well as the mid cap index, do you have some targets out there? Will they participate now?
Yeah, I mean, it's interesting. About a week and a half ago, we actually saw the small cap index break out as well as the mid cap index. Now, both those indices, if you look at it relative to the Nifty, have underperformed for roughly 10 months. And those relative charts are starting to come showing improvement. And we think the breakouts in absolute terms for both Nifty small caps and the Nifty mid cap is one of those laggard trades that plays catch up into year end. So, slightly more upside, roughly 3% more in the small cap index into year end versus the Nifty's target. So yes, we think that does play catch up.
Got that. Lawrence, do you want to get into, dive into what you like here, sectorally in India, which, some of what you discussed, but a little deeper, stocks that you think are the best, are placed the best way in terms of setups?
Yeah, unfortunately, I can't talk stocks, but we can obviously focus on the key sectors, and it remains banks, and within banks, if we have to get more granular, it's the private sector banks which are underperforming the public banks. So if I look at the PSU Banks Index versus the Nifty Banks Index, that's really been the key outperformer since 2021, and we think that continues. So if you had to get more granular within the banks, public sector banks stand out, and then I think a fresh breakout that's starting to develop, it comes from the infrastructure space. And if I had to break that down further, the property developers look really interesting as longer term leadership coming from property developers, but also from the telco side. So we've seen some broadening of that participation coming from infrastructure.
Okay, so you're still gunning for the banks. How about IT? It's had a really rough ride this year. Do you see the fortunes change?
Not as far as long-term leadership, but as far as a mean reversion trade into year-end, yes, we can see a bit of a catch-up trade there, but think of that more as a mean reversion trade rather than returning to strong leadership. We think that remains with the banks.
Okay, all right. Lawrence, one sector that's done very well has been the auto index. But now suddenly in the last month or so, I've seen some bit of an underperformance is taking place on the auto index. What's your sense on this front? On a fundamental side, some of those positives are in the price. Where do you see this one headed?
Yeah, it's an interesting one. There's basically two sectors where you'd want to be taking profits, and autos is one of them. If you look at the sector chart, you've got the double top pattern, you've got slowing upside momentum. Some of the key stocks have already rolled over, breaking below the lows that they set up in October. So we think that's a space that you can take profits in and rotate into the likes of infrastructure or even IT as that laggard trade. And the other sector is fast-moving consumer goods, where we've also seen slowing upside momentum, double top resistance, and it's another sector where you want to be taking profits.
Got that. Lawrence, your view on oil, extremely bearish setups, Yesterday we saw that 3% pop only to be sold into. I think it's a bearish outside day once again, the second in the last 5 days. What are your targets?
Yeah, so what we've seen in Brent is basically the day after Thanksgiving, we saw a break below $85. That had been the floor for Brent over the past 6 months. That breakdown basically gives us a downside target towards the $65 to $67 area. So again, back to the December and April 2021 lows. So we think there is downside risk, and 85 to 88 now becomes the new resistance area for Brent.
Since you are expecting the possibility of a bear market in the US, do you think that could threaten your Nifty target of 20,180? Or will the Nifty continue to be resilient irrespective of what happens across the globe?
Yeah, so I think having another pullback towards the end of the first quarter, start of the second quarter next year will likely pull back the Nifty, but we're not expecting the Nifty to retest the lows that it made mid-year, and we think will hold in a more resilient pattern, outperforming US as it's done through the corrective phases this year.
All right, Lawrence, final question before we let you go. Then the dollar index, that's come off considerably from that 115 odd mark, and on a day-to-day basis, it's been moving lower, currently holding at around 104.5. Where's that one headed?
Yeah, so I think into the new year, we test the 100 area to 101. That's basically the 2017-2020 highs. If we're right that we do see a corrective period after our first quarter peak in equity markets, we think the dollar can rebound again. But we're unlikely to go back to 115. We think a peak around the 110 area and any rebound in the first quarter of 2023. And that's likely to develop a major topping pattern for the dollar by the end of 2023. We think the dollar index could be trading closer to that 95 area on that type of topping profile.
All right, Lawrence, we'll leave it at that. Thanks for your quick chat and your view on the markets. That's Lawrence Belanco of CLSA, expecting the Nifty to hit 20,180 by Jan or Feb of next year. So he's quite bullish, but he's saying that there is a bear market rally that continues in the US, and over there things could perhaps get worse. So, well, dividing views on both global and the Indian markets. Let's slip into a quick break. On the other side of the break, our entire research team will be with us to help us with a list of top 10 stocks. Stay tuned.
CNBC-TV18, celebrating 23 years of
Welcome back. There are plenty of stocks in focus, so let's get to that very quickly. HCL Tech is the first one on our radar. In a very peculiar fashion, HCL Tech mid-quarter has guided for an FY23 revenue growth to come in at the lower end of its range. Reema's here to tell us what transpired. Reema, this is very odd, right? I mean, HCL Tech generally doesn't change its guidance mid-quarter, but give us the latest.
So HCL Tech has an ongoing US analyst meet, and over there the company has said that growth for this year, FY23, in constant currency terms is going to come at the lower end of their guided band of 13.5% to 14.5%. Now this is a bit surprising because just 2 months back, in mid-October, when the company released their Q2 numbers, the company had in fact upgraded their guidance. Their earlier guidance was 12 to 14%. And then in mid-October, the company raised it to 13.5% to 14.5%. So the lower end of the guidance was upgraded, and even the upper end of the guidance was upgraded from 14 to 14.5%. So 2 months into that quarter, the company has now said that growth is going to come in at the lower end. What we understand, the company has said that it's on account of volatile macros and higher furloughs. So furloughs typically mean that companies towards year end shut down for maintenance and, because of seasonality, the holiday season, etc. This time there was lack of clarity whether the furloughs will be higher than usual. Typical seasonality furloughs will be there, but this time, because of the weaker macros, will companies decide to shut down for a little bit longer, say production, say factories, etc. And we understand that there are higher furloughs seen in BFSI as well as telecom. Now, in BFSI, we know mortgage segment was weak on account of rising rates, but are there other segments which are slowing down in BFSI? And telecom, that's a segment that we're hearing which is weakening for the first time. So that is also fairly, important. So this is an important update that HCL Tech is now saying growth is going to be at the lower end of their guided band. Back to you.
All right, Reema, thanks very much for that. So keep an eye out on that one. Let's revisit Paytm, of course, with the news in terms of what has been announced. And, of course, it's the buyback which is going to be considered by the company on Tuesday, next Tuesday. Abhishek is here with more. Abhishek, hi, morning.
Morning, Prashant. So as you mentioned, the company has decided to hold a board meeting to consider a buyback option on 13th of December. Just to alert our viewers, the cash and cash equivalent in the balance sheet was around 9,182 crore as of Q2 FY23, around 9,411 crore as of Q1 FY23, and about 9,271 crore as of FY22. So the total net worth was around 13,564 crores. Remember that last year in November November, they had raised about 8,300 crore of cash via IPO. So SEBI rule says that, on the maximum side, you can have 25% of the net worth, which could be considered via the tender route in terms of buyback, and about 15% of the net worth on the maximum side can be considered via open market for buyback. So hence, the calculation on the maximum side shows that, there could be a buyback of around 3,391 crore via the tender route, while, via the open market, they could have a buyback of around 2,034, 2,035 crore. Just to alert our viewers, the IPO was priced at around 2,150. Currently, it's trading more than 76% below its IPO price. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Shilpa. She's joining to tell us about HUL. Shilpa?
HUL's foray into health and well-being comes with two strategic investments in this space. Now, the first is a 20% stake in Wellness Nutrition. It's a D2C brand founded in 2019 with an annual run rate currently of about 50 crore rupees. Now, the second one is a plant-based nutrition brand, Oziva, and this is happening in two tranches. 51% now for about 264 crore rupees and the remaining 49% 36 months from now at a pre-agreed valuation. Now, Oziva had an annual turnover of about 124 crore rupees in FY22, and HUL will have a board seat on both these companies. Now, while these deals are smaller in size, HUL sees about a 30,000 crore rupee opportunity in this space 4 to 5 years from now, and analysts are also upbeat about the fact that HUL has a proven track record of significantly scaling up smaller acquisitions. Now, WeWash and Indulekha are cases in point, and HUL has also said that it will look at bringing some of its global health and well-being brands from the global portfolio to India at an appropriate time.
Okay, this health and well-being market is growing at a rapid rate. There is an expectation of it being a 3 lakh crore market in the near term, and HUL getting into it now. But let's go across to Surbhi. She's tracking some of these insurance companies this morning. Surbhi, over to you.
Hi, thanks for that. The insurance companies will be in focus today. That is because the IRDAI has allowed foreign investors, including FPIs, to invest in preference shares and subordinated debt issued by the Indian insurance companies. The quantum of these investments cannot exceed the sectoral cap. The total capital has to be lower than 50% of the total equity or the net worth. They've also allowed the subordinated debt to be listed on the local stock exchanges. Additionally, the domestic insurance companies can also invest in these debt instruments issued by other insurance companies, but the only stipulation here is they cannot invest if they have a common promoter. But overall, good news coming for the insurance sector.
All right. Thanks very much, Surbhi, for that. Now, Triveni Engineering and JSPL in focus. Vivek is going to tell us why. Vivek, hi, morning.
Well, good morning. Yes, so Triveni Engineering, the entire Triveni group, both Triveni Engineering and Triveni Turbine, since the end of the September quarter, have been striving to simplify the cross-holdings that they held in each other. Remember, in September 2022, Triveni Engineering exited its entire 21.85% stake in Triveni Turbines. And along those lines, in yesterday's trading session, the promoter of the company, Dhruv Manmohan Sawhney, sold almost 7.03% stake in the company. He held over 15% stake at the end of the September quarter. Some of the marquee names that were buyers included Societe Generale, Plutus Wealth Management, as well as Anil Kumar Goel. On the other hand, keep an eye out for both SAIL as well as JSPL. Now, newspaper reports are indicating that the railway budget this time could be very strong in terms of the railway capex that you could see. So the Union Railway budget could propose laying almost 100,000 kilometers of new train tracks over the next 25 years. And in FY24 itself, you could see 4,000 kilometers worth of tracks that could come in. So that basically implies almost a 30% increase from FY23 in the budgetary allocation as far as railway capex is concerned. So both SAIL and JSPL will be in focus on the back of this particular proposed increase, and also keep an eye out for, given the fact that SAIL also supplies wheels, and we understand that they've been asked to increase that particular segment as well. We haven't independently verified these reports.
And let's see how much can it contribute, Vivek. But normally these are higher margin businesses, so let's see how that works. Thanks so much for joining in and filling us in with all of those details. Well, here's a recap of all the top stocks that we covered. Stocks with positive news flow include Paytm, HUL, HDFC Life, SBI Life, ICICI Prudential Life, Star Health Insurance, Triveni Engineering, JSPL and SAIL. While HCL stock is the lone one that could react to a negative news flow.
All right, but one thing that's really working in favor of the markets is the fall in crude, and it's positive for Indian macros. Manisha Gupta joins in now for a roundup of all the action from the commodity market overnight. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, 10% down this week for the crude oil prices, and we are down 20% in last 1 month for the crude oil prices. It also is the money moving out as you are heading towards the holiday season. So the prices have swung into a contango, and hedge funds and money managers are cutting long positions. Investors also are assessing sanctions impact on Russia. But in the meanwhile, it is also about the weak data that we have seen come in from UK, European Union and China, and the US officials sounding alarm on potential recession in 2023 also continues to weigh on the crude oil prices, but not so much on metals, because when you look at the prices today, whether it's copper, aluminum and iron ore, all of that yet again trading in the positive.
Thanks very much, Manisha. Appreciate you joining in with that perspective. That's oil prices in focus. We'll take a very quick break here. We'll come back, and on the other side, Anand Tandon will be with us to talk about market fundamentals, sectors, and what's his view near term. We'll also connect with Shashank Srivastava of Maruti Suzuki to talk about the latest demand trends. What's the picture on the ground? That conversation follows as well. Stay with us.
Welcome back to Bazaar Morning Call. Hope you're having a good Friday morning and set for a long day and then a good weekend ahead. But before that, we need to discuss quite a few stocks, and to help us out with that, we're joined by a market expert, Anand Tandon. Morning, Anand. Thanks so much for joining in. Well, Anand, the news that came in just an hour or so ago was that HCL Tech, they are pulling back on their guidance, and they're guiding now to grow at the lower end of what they said earlier. Your take on HCL Tech, valuation-wise, it's always been at a bit of a discount. So your take on the IT space as well as HCL Tech?
Well, as you were discussing a bit earlier, I think the IT space is, generally been underweight for most funds for the last few months, at least the last 6 months, largely because of expectations of slowdown. HCL's guidance was a little bit aggressive, so I don't find it surprising that they are slowly cutting back. By and large, just about double-digit growth on the top line is what you should expect. Bottom line would be smaller than that for this year. And therefore, the only question that you're looking at is from a valuation perspective. My own belief is that the market generally is somewhat overpriced, and consequent to that, the IT sector, even though it appears more expensive from a historical perspective, is not particularly out of line. And therefore, I would kind of maintain a neutral stance at this stage, which means that for most funds, I would imagine that you should expect to see a little bit of buying.
Okay, expect to see a little bit of buying, but you're maintaining a neutral stance on IT. Got that. What about Paytm? The buyback announcement has been subject of a lot of scrutiny. How would you read into it? And if you are, or if someone is a long-term investor in Paytm, what's the suggestion now?
So first of all, the easier question to answer is the long-term part. If you are a long-term investor, you have no reason to be in Paytm even today. I mean, there is no particular area where you can see a clear growth path. You could argue that they are going to become a lending company, a market, but until they reach any kind of market leadership or near market leadership position, I don't think that is visible, and the valuations still assume a lot of optimism. The other question about whether they should be doing a buyback, I think, the management is trying to signal the fact that they personally feel that the stock is underpriced and that they have a path to profit. If that works out to be the correct assumption, then obviously you would probably have got it at a good price. So you may want to kind of get in from that signal point of view. But my own argument is that, talking is one thing, executing is another. And other than the fact that they have executed very well during the pandemic, where they went out and got a whole lot of accounts for their payment side of the business, which has no path to profits. I have yet to see anything which makes me believe that there is something that you should be really looking at.
It's going to be an interesting thing to talk about, right, Anand? I looked at the amount of money, and we'll try and pull the graphic up from, this was a piece I did last Friday. The amount of money which Paytm is raised as a private company, right, till the time, in the private life cycle, till the time it hit the IPO, was about $4.5 billion or so. And its current market cap, I'm not sure, but it's around there. This is so sobering, right, as a data point. the market cap of a company is equal to, it actually fell below the equity it raised as a private company. So it just tells you the amount of destruction, wealth destruction it has happened even before, for investors even before it came to the market. Just a quick point though, one can make the case that when for these digital companies, I mean, it was premised on the fact that growth rates are going to be very high, the market opportunity is very large, but typically you would do a buyback when you don't have better use for the cash, right? So that's the flip side, isn't it, Anand? You're doing a buyback now, well within your rights to do one, but what are your thoughts?
No, you're absolutely right. Typically, you would expect to see a buyback when the prices have fallen dramatically and the growth rate in the company is slower than what you would think that the company can generate through the stock market. But in this case, the question is that perhaps the only way you can generate anything is through the stock market, because the company ain't going anywhere. So from that perspective, it's perfectly valid reason to be doing a buyback. I think it's more a signaling device. Clearly, it's not as if you're going to buy a huge potload of your shares back. So it is essentially telling the market that, hey, the insider thinks that it is a good time and a good price to be looking to buy. So I don't think you should read anything more in terms of corporate strategy beyond the signaling.
Anand, yesterday Sonia had she had covered a note by Nomura. Well, they were suggesting that for lower end vehicles, there is some discounts out there, which could be good news for customers. But the broader read-through is that maybe demand is not that good. How do you approach this space?
Well, clearly we've seen that for a while, that the only place where there is a demand right now is on the premium side, whether it is vehicles or any other kind of category of consumption goods. So, and you can understand that because clearly there hasn't been any kind of significant job growth. There has not been a significant wage growth. And in rural India, most of the wage growth has been negative in real terms. So as a consequence, we have yet to see a demand revival in rural India, and whatever is happening in urban India is happening at the higher end of the income curve. And that is why we are seeing SUVs and premium goods doing well. So you can see flights going full. You can see tourism and hotels doing well, but you don't see the lower end of the consumption picking up in any significant way. So I think that trend is what you are calling out right now. And, it's likely to persist till we find either a more broad-based kind of wage and income growth, for which I see no evidence so far, but it could happen. And if that happens, then you will probably see a growth. Otherwise, you have to go back and rely on the fact that the crop this year may be better, because in the second season, apparently sowing has done very well.
Okay, in fact, let's put this question to the management themselves, right? So the note that we're talking about, the Nomura note that came out yesterday, spoke about increasing discounts in the small car segment because of a fall in demand. Nomura says that discounts have gone up by almost 15 to 30,000 per model compared to last year. And this, they say, could impact profitability as well. So we find out with the largest player in this space, Maruti. Shashank Srivastava, the Senior Executive Director, Marketing and Sales at Maruti, joins us now. Mr. Srivastava, good morning. I wanted your thoughts. Have discounts gone up that much? And is it also because demand for this segment is waning a bit? I mean, there is this K-shaped recovery that we're seeing across the board, right? One pocket of the market is doing extremely well, which is the premium end, but the lower end is just sulking for a long time now. Your views?
Yeah, so a couple of things, quick points I would like to make. Sure. First is that, discounts are really a function of the gap between demand and supply. It is not really a function of one-sided variable of demand. So if the supply is larger than the demand, there will be discount, even if the volumes are large. So to say that the smaller cars have larger discounts and therefore there is no demand is not correct. In fact, if you look at the April-November current financial year, the top 5 vehicles in the industry are all small cars. The top one is WagonR, followed by Baleno, Alto, Swift, and the Desire. So the demand cannot be related directly to the discount. It is that the supply of these vehicles have fortunately been higher, and that has led to the higher discount levels.
Just
Secondly,
one follow-up.
when you
Sorry, Mr. Srivastava, just one follow-up, because you had mentioned in November, when we spoke, that the production was impacted because of supply constraints and you're likely to see a higher shortfall in December. Just wanted to understand how much lower can the December production be relative to November, and would this chip shortage continue in Q4 and beyond? I mean, just to get an understanding of how things could progress.
Yeah, so the chip shortage, I've been saying, and I think in the last interaction we had, Sonia, we had this, that while it is 95, 96%, almost there, but that 4 or 5% matters a lot. For that, there is very little visibility going forward, and as a result, it's difficult to predict exactly when the semiconductor thing will go away. Clearly, it is still there, especially in some models. Remember, the chips are not just semiconductor components, or not just, they are not generic in nature, they are also model specific. So we have found that in some models, we have seen smaller production and hence no discount, and also, in fact, long waiting periods.
Mr. Srivastava, hi, good morning. It's an interesting way to put it, right? I mean, that demand supply, the way you answer it, so there is greater supply is what you said, but there's not, obviously, demand will not rise up to meet it immediately. I mean, it takes time, and hence the discounting. But could you provide us with some perspective on what is the level of discounting now compared to in small cars? And this is not just with you, but it's an industry phenomenon as compared to, say, 2 quarters back. And in any case, the market has been betting on the fact that Maruti's mix will change towards higher-end cars, and that's essentially the reason why consensus expects your margins next year to expand by about 200 basis points compared to where you are now. So just on both those points, level of discounting, relatively speaking, compared to 2 quarters back, and margins from here.
Yeah, so if you look at 2 quarters back, definitely the discounting this month is higher. And that's because of the improved supplies of the models, especially our 1 liter models, which means the Alto, the Celerio, the Espresso, the Wagon-R, the Ignis, and so on and so forth. So clearly the supply has become better, and the proof of that is that you have seen record sales of these models. In fact, Alto has been the number 1 car in September, in October, and number 2 car in November. So that is what I meant by saying that the volumes are large. However, if you are looking at an overall trend of the last 3 years, yes, both in absolute volumes as well as in percentage of the overall industry, the hatch segment has gone down. It is now around 36%, used to be about 43% 3 years back. So there is a sharp fall in that sense. However, this year we haven't seen that fall. In fact, it has remained steady at around 36% of the overall industry. As far as the future of the profitability is concerned, of course, profitability is not just a function of model mix, but also a function of the overall cost structure, which includes your material cost. In fact, material cost being 75-77% of any auto OEM cost is obviously the most important factor.
Hi, Mr. Srivastava. I wanted to ask you about a couple of other regulations that will get implemented in 2023, which could have an impact on cost, and I want to understand how well prepared you all are. Now, RDE, that's real driving emissions, that's going to be implemented in April 2023. So what could be the cost increase because of that? If you could give us a rough number or some kind of quantitative data. And also the other factors, the airbags, they're going to be implemented, I believe, in October 2023. What kind of a cost increase, and is that on? Go ahead, sir.
Yeah, so on the RD, as you rightly pointed out, we have actually not just the RD alone, but we also have the OBD, which is the onboard diagnostics, which comes in from 1st of April. That is part of the phase 2 of BS6. And you are right, that should increase the costs a little bit. We don't know, it varies from model to model. All I can tell you is that for the petrol vehicles, it would be much lower than for the diesel vehicles. And that is what would make actually the gasoline vehicles a much better proposition going forward than diesel. And that was one of the reasons why we chose to get out of diesel a couple of years back, because the RD norms are the cost of complying with the RD norm for diesel is very high. So you are right, but in some of the models, we have already implemented and made those changes in the product for meeting the RD norms as of 1st of April. Some changes would be made in the intervening period, and that is one of the reasons why we have said that there would be a price increase in January.
Okay, one final question. You had earlier set a target of 50% market share in passenger vehicles. However, for the current fiscal year to date, right, you haven't, in fact, there's a slight fall that we've seen in market share for Maruti. Just wanted to understand what is the market share right now exactly, and do you think it may be hard for you to meet that 50% target?
So it is just above the 42% mark at the moment, April to November. And yes, as I have mentioned, in the non-SUV market share, Maruti's market share has crossed the 65% mark, which is an increase over the previous year. However, market share in SUV needs to be pushed up, and that's the reason why we have introduced the new Brezza, the Grand Vitara, and we'll be introducing a few more SUVs very shortly. But of course, the overall effect of these vehicles which have been introduced, the Grand Vitara having been introduced in end of September, and a couple of more SUVs which we should be introducing shortly, will actually the full effect of those volumes on market share will be felt over a period of time and not probably this year.
Okay, Mr. Srivastava, thanks a lot for joining in. We thank you on that note, but let's take a quick break. Up next, we'll be joined by Mitesh Thakkar and Kush Bora for some technical tips, so do stay tuned in.
CNBC-TV18, celebrating 23 years of business leadership.
Okay, welcome back. The SGX Nifty has kind of moderated its gains. It was up almost 80 points. We got about 70 now, 34% higher. 18,796 is where we're at. Mitesh Thakkar and Kush Bora are with us with some perspective on what to do this morning. Gentlemen, good morning. Good to have you here this Friday morning. Mitesh, you go first. How are things set up? I mean, you get a gap up, but what do? Or you wait for a bit of a dip?
Morning, Prashant. So I think on the Nifty, nothing much will change with the gap up. We still believe that the index is consolidating. What could be more interesting is the Bank Nifty. It's broken out of a good 8-9 day kind of consolidation on the upside. And I would now look at targets of 43,950 and in a good case 44,400 in the short term. I think, of course, the medium term targets remain much higher. So I think the Bank Nifty, if the gap up is still tradable, then I think we'll take longs over there or explore long positions in banking and financial names. But on the Nifty, I think around 18,710 is the hourly pivot which I'll be watching. In case we reach over there and then don't see any kind of strong follow through, we might reduce our exposure on the stocks as well, the non-banking, the non-financial ones, and then wait it out. I think the index is still consolidating, but the Bank Nifty is already broken out, so that's the one to focus upon.
Okay, that clearly has been the one to focus on all year, right? At least in the last couple of months. But just a word from your end, Kush, on the market. Is it still going to be led by the Bank Nifty, or do you see some new leaders emerge? And while you're at it, tell us about individual stocks as well.
Sure, Sonia. First of all, thanks for having me on the show.
Sure.
The leadership is going to remain with Bank Nifty, but very encouragingly, a lot of other sectors are going to participate. Like, you've got Virat Kohli scoring the century and everyone else just chips in with a, quick 20, 30 runs, right? The interesting thing on the Nifty is that the index, the VIX is low, and hence the moves are very gradual. They aren't very sharp, but for sure with a positive bias. The dip that we saw earlier this week is also a fresh entry opportunity. And, IT did its bit and metals and FMCG now contributing. I think the overall setup looks positive, for a buy on dips kind of a strategy on the Nifty. So 18,800 is where we see Nifty, moving to in, the coming week. 18,550 would be the stop loss. Now, interestingly, for Bank Nifty, the PSU banks have done all the heavy lifting. In fact, the PSU bank index is up 50% since October. And when I speak to a lot of participants, not everyone's convinced about this rally, which tells me that there are yet more people to, more participants to join the party. So Bank Nifty rally will continue. Targets fairly similar to what Mitesh already mentioned, 44,000 and 44,400. My stop loss here would be 43,300. On the stock specific front, two of them, L&T, it's been a little late to the party. The entire pack had moved. It's joining late, but it's, doing its thing now. 2200, 2250 is where we see, this going in the coming days. 2150 would be my stop loss. And with the metal pack, seeing the kind of rise, due to the China curbs lifting, 480, 485 would be my target on Hindalco. 465 is where I'll place my stop loss.
Okay, all right. Thanks for that, Kush. Mitesh, what about you? Individual stocks?
Yeah. Morning, Nigel. I have more of buy calls today. Bharat Forge is a buy with a stop at 859 for targets of 900. Astral is a buy with a stop at 2040 for targets of 2115, and a buy on Ramco Cement with a stop at 720 for targets of 750. The solitary sell call is Sun Pharma on a mild pullback around 988, 990. Sell with a stop at 1005 for targets of 955.
Okay, let's do one thing. Let's take a quick break on that note. On the other side of the break, though, we'll have the pre-opening rates. We'll also have Vishal Manchanda of Systematics Group to put focus on the pharma sector. Do stay tuned in.